Have you already watched the discussion about assets? This video is the continuation of it and will talk about the remaining elements of financial position, which are liabilities and equity, as well as the elements of financial performance, namely income and expense. Liabilities is a present obligation to transfer an economic resource as a result of past event. To further understand what really a liability is, here are the essential characteristics of a liability. First, the entity has an obligation. The entity has a duty or responsibility in which it has no practical ability to avoid. It can either be legal or constructive obligation. Second, the obligation is to transfer an economic resource. It includes an obligation to pay cash, obligation to deliver goods or non-cash resources, obligation to provide resources at some future time, obligation to exchange economic resources with another party on unfavorable terms, and obligation to transfer an economic resource if unspecified future event occurs. And lastly, it is a result of past event. It is a result of past event if the entity has already obtained economic benefits and that they must transfer an economic resource. Let's continue the example given. The acquired equipment was purchased on account. There is a liability because there is an obligation to transfer cash, an economic resource, as a result of the purchase past event. Just like assets, liabilities are also subdivided into two classifications: current liabilities and non-current liabilities. Current liabilities. These are financial obligations that are due within 1 year or within a normal operating cycle, whichever is longer. Operating cycle is the span of time from purchase of inventory converted into cash or cash equivalents. Specifically, the liabilities are current if you will have to pay it within the normal operating cycle. An example is when you purchase an inventory on account and has a 60-day term. As a result, you have an account payable that you will have to pay within 60 days, which is considered as current. Next, if these are for the purpose of trading. An example is a promissory note you issued in which you have intention to repurchase it in the near term depending on the changes in its fair value. It is a current liability because you may buy back what you have issued regardless of when you will pay it. Another, if it is to be settled within 12 months after the reporting period. Example is accrued expenses. Utilities expense are accrued but not yet paid. You don't pay it on a monthly basis, but instead you accumulate it and you will pay it all at once after the period. As a result, you have the obligation to pay what is being accrued at the end of a particular period. And lastly, if the entity has no unconditional right to defer the settlement for at least 12 months after the reporting period. Example is if the non-current asset became due within 1 year, like bonds payable. The issuer makes a formal promise to pay the interest and principal amount at a specified date some years in the future. Let's say after 5 years. It will be classified as current liability at the end of the 4th year because it will mature 1 year after this date. If you can no longer extend the payment for it and you have the obligation to settle it, then it will still be a current liability. Otherwise, it will be a non-current asset. In short, these liabilities are short-term in nature. Non-current liabilities. An entity shall classify all other liabilities not classified as current as non-current liabilities. It includes non-current portion of long-term debt, lease liability, deferred tax liability, long-term obligations to entity officers, and long-term deferred revenue. This is the counterpart of current liabilities because these are long-term in nature. Equity. Equity is the residual interest in the asset of the entity after deducting all of the liabilities. In other words, it is what is left of its assets after satisfying its obligations. For example, Jane has available cash of 5 million pesos asset to pay for the equipment that she bought on account for 3 million pesos liability. Before the year ends, she pays her obligation for the purchased equipment. After satisfying her obligation, she now only has 2 million pesos, 5 million pesos minus 3 million pesos, that will represent her equity. The equity accounts may differ from different types of business, but the definition of equity doesn't change. For sole proprietorship business, it composes of owner's capital and owner's withdrawals. The owner's capital account, also known as owner's equity, is the invested amount of money that the owner puts into the business. Owner's drawings account, also known as withdrawals, is used to track the amount taken from the business for personal use. This is a deduction to the total owner's capital account. Except for the number of partners' equity accounts, accounting for a partnership is the same as accounting for a sole proprietor. Each partner has a separate capital account for investments and his / her share of net income or loss, and a separate withdrawal account. For corporations, their equity is composed of share capital, share premium, retained earnings, and treasury shares. To further understand, let's define each one of these accounts. Share capital, also known as the paid-up capital or contributed capital. It can be a preference share capital or ordinary share capital. Ordinary share capital is so called because the ordinary shareholders have the same rights and privileges. They enjoy no preference over each other. Ordinary share gives the owner right to vote, to share in income, and in the event of liquidation, to share in all assets after satisfying creditors and preference shareholders' claims. Preference share capital is so called because of the preferences granted to the shareholders. The preferences usually pertain to the preference shareholders' claims on dividend and net assets in the event of liquidation. Share premium, the amount paid by investors in excess of the par value on shares sold directly to them by the issuer, is referred to as additional paid-in capital. Par value, also known as nominal value, is the stock price stated in a corporation's charter. Retained earnings is the amount of earnings generated by a business to date, less the amount of any distributions back to shareholders in the form of dividends. Treasury shares is a contra account that contains the amount paid to investors to buy back shares from them. This account has a negative balance and so reduces the total amount of equity. Elements for financial performance. Income is defined as increases in assets and decreases in liabilities that results in increase in equity, other than those relating to contributions from the equity holders. The definition of income encompasses both revenues and gain. Revenue arises in the course of the ordinary regular activities. Gains represent other items that meet the definition of income and do not arise in the course of the ordinary regular activities. Gain usually occurs when you receive more than what you gave up. To further understand what is revenue and gain, let's have an example. Jane's business delivers goods to the customer for cash, which it is the ordinary conduct of activities of her business. The cash she receives with this transaction is considered as a revenue from sale. On the next month, Jane sold her old delivery equipment more than its carrying amount. The difference between the cash she received and the carrying amount of the asset is called gain. Expenses is defined as decreases in assets and increases in liabilities that result in decreases in equity, other than those relating to distributions to equity holders. expenses that arise in the course of ordinary regular activities and include cost of goods sold, wages, and depreciation. Losses do not arise in the course of the ordinary regular activities and include losses resulting from disasters. Examples: loss from fire, floods, hurricane, as well as those arising from disposal of non-current asset. There you have it, the elements of financial statements. I hope you've learned a lot. Thank you for watching.